Something happened in 1975 that changed investing forever. Before 1975, if you wanted to invest into the stock market, there were only really two feasible options. The first was to buy shares from a company and receive a paper certificate, but you had to do this via a stockbroker.
$350 Swiss.
Zurich 23, Citibank.
Now, a stockbroker was a fancy name given to a middleman who would basically steal all your gains through pesky fees charged when you buy these stocks. The problem with buying stocks was, like today, there is no way of knowing whether the stock certificates that you have hoarded are going to be worth anything in the future. So if you put all your eggs into one stock basket, when push comes to shove, you just might end up looking at a whole bunch of yolk. The other option that I was talking about was to invest into mutual funds. These are funds where investors can get a slice of, and the fund placed different allocations of money into securities such as stocks and also bonds. The problem with mutual funds, however, was that they were actively managed. Greedy fund managers would take a huge portion of your gains whether or not the stock market was going up or if it had gone down. In 1975, however, everything changed when a new investment product was introduced to the world, revolutionizing the way we invest. This was the exchange traded fund, otherwise known as ETFs. In 1975, the Securities and Exchange Commission, the SEC in America, deregulated brokerage commissions. This change in deregulation led to a rise in stockbrokers who offered lower commissions to those seeking to buy stocks and bonds. With the introduction of discount brokers, the world of investing was now available to almost anyone. But there was still one big problem. Buying individual stocks was risky and required a lot of time and research. This is where John C Bogle of Vanguard comes in. He seized the opportunity of the changing landscape and created the first ever index mutual fund. Bogle's idea was that instead of beating the stock market and charging very high fees, the index fund could instead track the performance of the stock market over the long term, thus achieving higher returns with overall less costs. These costs were a whole lot less than actively managed funds, and overall he saw that the stock market would always beat these actively managed funds. He had a famous saying, "Don't look for the needle in the haystack, just buy the haystack." This is where the ideas of ETFs actually came in. ETFs are a type of investment funds that trade on the stock exchange just like normal stocks. ETFs are designed to track the performance of a specific index. For example, the most famous you may have heard of is the S&P 500, the Standard & Poor's 500 index. This is a collection of the top 500-ish companies within the USA. The ETF therefore provides the investor exposure to a well-diversified portfolio of stocks and even bonds. The first ETF was the SPDR S&P 500 ETF, ticker code SPY. This was launched by State Street Global Advisors back in 1993. Fun fact, it recently just had its 30-year anniversary. The SPY tracks the performance of the S&P 500 index and has since become one of the most popular ETFs in the entire world. So since then, ETFs have grown so much in popularity and diversity, with new ETFs being introduced all the time that track different sectors, different regions and different asset classes. Today there are thousands of ETFs that you can choose from, giving investors lots of choice over diversification and asset allocation. There's even an ETF named after the financial YouTuber Meet Kevin, and this is a great way to make him richer whilst also potentially losing out to average market returns. One of the key benefits to ETFs are their very low cost. Because they are passively managed and traded like a stock, they usually have a lot less fees than traditional mutual funds. ETFs also benefit from being very liquid, meaning that they can be bought and sold throughout the day just like normal stocks. Another benefit of ETFs is that they are very flexible. They can be part of your investment strategy, whether it's about diversification, hedging, or even income generation as you get closer to retirement. So overall, ETFs have had a profound impact on the investment landscape, providing investors with low cost, flexible, and diversified way to invest into the stock market. Despite their many benefits, ETFs have been no stranger to criticism or controversy. Many have argued that the rise of ETF investing has contributed to market volatility and increased correlation between different sectors and stocks. As investors, we would like to think that different asset classes are not correlated. For example, we feel safe knowing that when the price of the stock market goes down, prices of commodities such as gold doesn't go down with it. Others have raised concerns that ETFs can be used for market speculation and manipulation. However, on the opposing side, people say that ETFs have democratized investing and made them accessible to a wider range of people. ETFs have also been credited to drive down the costs of investing in the stock market and improving the overall efficiency of financial markets. In recent years, the popularity of ETFs has soared. More and more investors turn towards ETFs to get greater exposure to the different asset classes and sectors. The global ETF industry is now worth more than $8 trillion, and Vanguard alone has around half of this under management. This is expected to continue to grow throughout the years. In the UK, there has been a rise in new stockbrokers which offer low-cost ETFs with no additional fees. Namely, these brokers are Freetrade, Trading 212 and InvestEngine. The low-cost and diversified nature of these ETFs make them very popular for new investors. Furthermore, there has been a huge influx of financial influencers recommending ETFs for long-term investing. Some analysts are worried that the influx of all this cash into these ETFs put some companies in a position where they are overvalued, and this creates an ETF bubble that is almost definitely going to pop. Looking forward, it is clear that we're going to keep seeing innovation in the ETF landscape, with new ETFs being introduced and current ones being updated to meet the ever-evolving demands of investors. One area that is likely to see significant growth is within ESG, so that's environmental, social and governance. Because ETFs track a particular index, they're so well diversified that if a company doesn't do so well, they can be kicked out of the index. This gives the index allocators so much power over which companies get to be featured on certain ETFs. So in conclusion, the history of ETFs is a story of innovation and evolution in the world of investing. From the humble beginnings back in 1975 to today's Meet Kevin ETF, there are no doubts that John C Bogle of Vanguard created a revolution, bringing more and more people into the world of investing. As the ETF industry continues to evolve, it will be very interesting to see what it brings us investors in the future. So if you wanted to keep up with that, make sure to check out some of my other videos, and I will see you in the next video.